Finance can be messy, but don't worry, we clean it up with facts, fun, and maybe a little sarcasm. Welcome to the Financial Sandbox. Let's get into it. Today, my guest is Matt Calabrese from Carter Funds, which is also Carter Exchange and Euphorio Carter. So first of all, what are the three names all about? At least those are the three that I know.
Yeah. So Carter Funds is the umbrella corporation, the umbrella company. Essentially, we're based out in Tampa, Florida, and Carter Funds is over $5 billion in AUM. We do 1031 exchange DSTs. We do multifamily programs where we buy multifamily apartments in the Southeast for value add opportunities. We develop properties as well, primarily in the Southeast. And then we also do data centers, which we just recently closed our first data center fund. That should end up being about 500 million in AUM. So we just keep adding to the real estate portfolio, so to speak.
So I'm going to halt you here on the acronyms. AUM, DST.
Oh, okay, yeah.
Right. So when we talk about assets under management, AUM, what do you mean by that? What does that mean to the general marketplace? Because I'm sure the general public sees that every place. What does it mean?
Yeah, it means that a company like ours, a company that specifically focuses on real estate, when you buy a property or portfolio, let's say the property is valued at $100 million, another property is valued at $300 million, one's at $50 million. So that's $350 million in AUM. That assets under management, those are the assets that we're managing. So the volume of the assets that we're managing.
Right. And the DST that we're talking about is called the Delaware Statutory Trust. That's an option in a 1031 exchange. And we'll get into that. And we're going to get into your data center a little bit. But I would like to know a little about Matt. You are in Southern California, right? And have a family, and you also have a military background. So tell us a little about you.
Yeah, that's correct. So I've been married now for almost 18 years. I have my wife and my son. We live in Southern California, Orange County, pretty close to John Wayne Airport. And pretty much, I've lived out here most of my life. Went to high school in Tustin. After high school, I joined the Marines and was in the Marines for 4 years and did some traveling. Then after that, I ended up in Chicago, working for Lehman Brothers mortgage division out there for a bit. And then made my way back to Southern California and pretty much been based out here most of my life. I just can't beat the weather, man.
Well, thank you for your service to the country and being a Marine. So tell me, when did you travel more, when you were in the Marines or being a wholesaler?
You know what? That's a great question. I think it's close. I have a big territory. I have the whole West Coast. So I have Alaska, I have Hawaii, Washington State, all the way actually. Yeah. So I'm a pretty big territory. But the Marines, in Cuba, I traveled mainly like a lot of different bases. We worked with the Army a lot. So, I ended up at Fort Benning and I got my jump wings, which was nice. We had a quota to attend an Army jump school. Went to Fort Polk, Louisiana for some training. But mainly spent most of my time at Camp Pendleton and 29 Palms.
Awesome. So your signal got a little weird there, but you traveled mainly up and down the West Coast, all the way up into Alaska and back as a wholesaler. Is that correct?
That's correct.
Awesome. That's great. So tell me about Carter. What you've been there almost 5 years, I think. Why has really Carter been that mainstay for you, and what is it that makes it home for you? What about the company?
It starts at the top. John Carter, our founder and our chairman, has a lot of experience, 30, 40 plus years in the real estate game. The team he assembled, I think we have like 300 years of experience in multifamily, like over 100 years of experience in data center funds, combined experience. So the team is very knowledgeable. They have integrity. I've worked at a few different firms in the alternative space, which sells products like we're selling here. And I have to say that Carter puts clients first, which I like. And again, they treat me very, very well. And we have a great product suite. You look at the things that are non-correlated to the market, and you look at what people are investing in. I think we're perfectly set up for at least in a sector that has high demand, high rent growth, and it is looking like it's going to be that way for the foreseeable future at least. So I like where I'm at, definitely.
When we talk about the alternative space, people hear that when they're reading about it or on Bloomberg and other programs. What are we talking about when we say alternative investments? Is that give us a couple of examples?
Yeah, they could be almost anything. Typically, they are considered Reg D, which means they're private programs and they have different accreditation standards. But it's different. It's different than a typical public stock where you can go in, put the ticker symbol in, buy however many shares you want, or like crypto, go in and do everything electronically. Alternatives are programs that are set up that are non-correlated to the overall public markets. So we're talking like oil and gas programs, real estate programs, all sorts of different programs, whether it's, healthcare, you name storage, you name it. There's a bunch of different programs that fall in that bucket. So they're typically programs that are not correlated to the market. And that means they're not liquid, but they typically come with a higher upside, meaning that when the program ends and liquidates or gets bought out by another company, people have a chance to make, significant IRR or a significant return on their investment once it ends. So there are some benefits to alternatives, but again, it's typically a liquid investment. So when you invest in it, you're investing in it for 3, 4, 5 years.
And this is a lot of what my show is all about, because I call it the financial sandbox because there's so many different aspects of financial services. And I think that what I really want to stress here is that it's not cookie cutter stuff. It's not stocks and bonds and mutual funds. There's so many different other spaces that folks can invest in.
Absolutely. There's a lot of variety out there. And I think, if you're looking at someone's portfolio, I mean, there's a spot for just about any kind of investment in there in terms of, you're looking at alternatives. I mean, and it's our philosophy. And I think a lot of financial advisors would agree that, if you're looking at your portfolio, there should be some exposure to illiquid or non-correlated investments. That way, if the market goes down or whatever, it's volatile, you have a portion that's leveling that out and creating, that non-correlated stability, which you're looking for in a portfolio. Every portfolio should have a piece of that at least.
Absolutely. And you guys have worked in a variety of spaces. One is the data center. You've also worked in multifamily, right? So let's start out with multifamily and what makes that a really good sweet spot for you guys.
So multifamily, well, I mean, it's a story that everyone understands because everyone needs a place to live. One of the taglines at a previous company that did multifamily was shelter over shopping. And I think that's very correct. People are going to pay their rent before they pay just about anything else. Right. And then you want to look at, multifamily is different. It's almost, there's different markets on the West Coast, on the East Coast. You're talking about the Midwest. We like the Southeast, and the reason for that is obviously there's a lot of states that don't have state tax, which is nice. But for corporations, in California, we saw Tesla leave. Companies are moving to Texas, to Florida. Chicago. King Griffin, Citadel Securities, $22 billion firm, moved to Florida because he thought Chicago was too dangerous. I mean, he'd been out there for years. Caterpillar moving from the West Coast to Virginia, I believe, Caterpillar moved to Virginia. There's just the names are endless. You can look at all the companies that have moved to the Southeast, and they need housing for their employees. So there's a market there that there's demand, there is a need for it. So what we'll do is we'll go in, and we're not building. We have done development, but for the portfolios that I'm talking about, we'll go in and find a community that maybe is a little bit older, that needs a little bit of love. We'll go in there and we'll renovate, partial units, maybe about 35% of the units. We don't do all of them because you want to leave potential upside or meat on the bone, as we call it, for an acquirer that comes in and buys it from us. They want to be able to add their value. So we go and we add some value, make it look nice, hold the properties for 2 or 3 years, bundle up, 5, 6, 7, 10 properties, and then sell them and then start our next fund. So right now we're on fund 4, getting ready to launch fund 5 in the multifamily space.
Wow. So you also work in what is called the data center space that's getting so much press today. How did you guys have been here for a long time too?
That's
You guys,
correct. Yeah, that's correct. We've done billions of dollars in transactions in data centers. So the team from a previous company, Carter Validus, had two very successful data center programs, which the returns were nice. Everyone was happy. John left that company, our founder, John Carter, in 2017 and started Carter Funds. And when the contracts and everything were done from Carter Validus, he wanted to get the team back together, got the same individuals that were responsible for, our chief investment officer, John Reagan, a lot of the people that worked in the back office, brought them over to Carter Funds, and we launched our Foreo data center fund, which again is focused on data centers, and it's a space that, just like multifamily, that we have a lot of experience in.
And I went to visit your property a couple of months ago. It was great. I kind of nerded out. It was just a great spot, great space, and an amazing center. But you have a handful of them across the country. Where are they located? And tell me a little about why you're in those locations.
So we're agnostic when it comes to data centers. And again, we're not developing new data centers. I know, Trump talked about, 500 billion infrastructure. I think they need to build 5 nuclear power plants for that kind of power. That's the biggest concern for data centers is power. So you want to be in markets where, data centers connected to the grid, a good power source, and they're all over the country. So we have, we call it a switch site, which it's a cell phone tower site. That's T-Mobile. That's in Ontario, California. We have another data center up in Connecticut. We have data centers in Bryan, Texas, which work as a disaster recovery site for the county that Bryan's in. Top 200 data center in the country. We have the one in Tucson that you visited that is more of an AI type of data center, but they're all plugged in to existing power grids. We just bought 2 more properties in Kentucky. So again, it's wherever a company is based. A lot of times they want to be either close to the data center or they have specific needs, which is nice. And they put their money in. So we'll buy the land. We own the real estate. We own the box. A company that is leasing that from us will come in and they'll put 50, 60, 70, 90 million dollars to upgrade the facility to the way they want it. And it makes them sticky. It makes them sticky tenants, because when you put that kind of money into a facility, you're not going to just bounce out and leave. I mean, this is critical infrastructure, meaning that if this data center goes down for 10 or 15 minutes, it cripples their operations. I mean, we have FedEx in there. FedEx, let's say, goes down for a half hour. Think about all the deliveries. Everything shuts off at that point. I mean, all their data is gone. So it is critical for them to make sure that they're in a data center that is operated well, and that they pay their lease. So they'll pay before they pay bondholders.
Right. It's interesting. I thought I was going to start this interview out with you talking about details and specifics, but I love this high level, right, that we're at here. And I want to stay here. Can you tell me a little bit more about the data center space? I mean, like, for example, you guys have the T-Mobile site. I think, if I remember correctly, correct me, but you guys can manage the data from Southern California, Arizona, Texas. I mean, of data that you are handling it was like 6 states, isn't it? Of people. Yeah. Tell me a little more about that.
Yeah, so there's 1,000 cell phone towers connected to this particular data center, meaning that anyone that's using that, their phone, if they want to order a DoorDash, they want to do anything, it's going through that data center. And if that data center goes out, something happens to it, a good chunk of Southern California, Arizona, Nevada, people are not going to have cell service. So they're vitally important to keep, obviously well maintained. I mean, there's 24-hour security. They're monitored at all times. Big generators, backup power, all sorts of stuff. And you saw a lot of that in Tucson. Just the amount of machinery that's required to keep the equipment cool, to keep it running and safe. It's mind-boggling.
Right. And I think there wasn't there an airline, an airport that went out. Was it the airport or an airline that went out, and it was because of their data center, right?
It was the FAA. The FAA's one of their data centers. Something happened. I actually was stuck in an airport for almost 2 days because I was traveling and that system went out and they had to ground all the flights. And it wasn't down that long. It was down, I want to say it was down like maybe 20, 30, 40 minutes, and it backed up. I mean, thousands of flights were canceled. It was nuts. And it was all just because a little blip happened in their data center. And you could see that the snowball effect from something like that. Whereas, if T-Mobile or FedEx, if their data center goes down, you think about everyone that FedEx overnights packages, sensitive stuff. I mean, important stuff, medical stuff would be impacted by that. So it really, they're vitally important that they have power, backup power, and that they run properly. And thank goodness, again, this is a space that we're comfortable in, that we do a good job at. So, the companies that are in the portfolio that we have, are taken care of. And again, they're spread throughout the entire country. So that's another thing. It's good diversification, not just, in one market, but we're in multiple markets. So it gives us, a lot more exposure.
All right. Well, let's get off of the data center things here. I love this space, and I think it's such a growing space, and opportunities there for growth and jobs and employment and all of that throughout the country and the world. I have friends in Europe who are working on data centers there, and it's quite amazing. So what are the other spaces? You guys are in multifamily, you got data centers, and there's other sectors that you're in as well.
So, well, we do development, and we had one development fund, but that is developing an A+ multifamily community. So typically we buy existing properties. We do have a fund that we closed 2 years ago that we already finished 2 properties in. So we do development deals, and then also for tax purposes, the 1031 exchanges. I know that we talked about that a little bit, and we have a team that specifically sells Carter Exchange. That's the name of the company within Carter that does the 1031 exchanges. And essentially, if you own, an income property of any kind and want to sell it, you can actually go into one of these programs, and typically they're multifamily. We're actually talking about a possible data center 1031, but you can go into one of these programs and not pay taxes on the proceeds from your sale. And then, whoever is going to inherit it, your heirs could get it at a step-up basis, which means at the original tax basis. So there are some nice tax advantages there. So we got a lot of different veins going out into the market, just in terms of, sector, type of multifamily, whether it's development, older, data centers, tax programs like 1031s. We've done, different bridge loans and things like that. So we're a fully integrated type company that has again different financial veins.
So not getting into any trouble with the regulators here. 1031 exchange, in a 1031 exchange, the Delaware statutory trust is an approved option, like-kind option when it comes to doing a 1031 exchange, which means that when someone sells an exchange, kind of telling my audience here that a portion of your proceeds can be utilized to purchase an equity share of a Delaware statutory trust. And there are many, many different options in multifamily, necessity retail, senior housing, industrial logistics, et cetera, et cetera. And absolutely. So there are many different options here, and I don't want to go too deep in there because then I'd have to do a million disclosures and disclaimers.
Yeah, that's good.
So I think my interview here really wanted to talk about Carter and you and where Carter is. It's a very interesting group, and one day I hope to have on some of your maybe your CEO, have Mr.
Absolutely.
Carter talk to him and the crew. I've met them, so I think they're great people to have on at some point in time. So where do you see the growth in the market right now? Is it the data center space? Is it multifamily? And granted, everything we talk about is in a snapshot of today.
Absolutely. So with multifamily, the market as a whole is approaching zero vacancy, meaning that, you look at from coast to coast, it's very hard to find data centers that aren't being leased. So that market is growing at an incredible rate. And like I said, you need a tremendous amount of power to develop data centers. So any new data centers,
some communities may not want them.
And some communities may not want them. A lot of times they're going to be out in the middle of nowhere. We have two in Simpsonville, Kentucky, and they are surrounded by thousands of acres of land. And going to your point, a lot of times they don't want them in their communities. And also, something we didn't bring up is in 08 and 09 during the Great Recession, data centers stopped being built. That was put on the back burner. So now, post COVID, here we are. And there's not enough data centers, so they're a precious commodity right now at this point, so to speak. Precious real estate. So
I think it's a lot of people don't realize that people like me who have never deleted any of their text messages over the last 12 years. It's all because of a data center.
I mean, everything you do. I mean, I was laughing with my wife about it. I mean, she could preheat our oven when we're out at the grocery store. So when we get home, it's already, set up. Same thing with like the washer and dryer, the microwave. Everything in your house is connected through a data center, whether you know it or not. Yeah. Every time you order an Uber, a DoorDash, when you're on a plane flying and watching a movie, all that's going through a data center. So there's I think the latest numbers, which I think are actually a little bit dated now at this point. Like 30 billion devices are connected to the internet. And I think it's closer to 40 billion now. So you have billions and billions and billions of devices that are going through these internet cell towers, you name it. And again, there's only so many of them. So if you're able to get into an investment or portfolio where you can bundle, 12, 13, 14 of these different data centers throughout the country, and then sell them to a large firm, whether it's a Brookfield or Blackstone or whoever, they're just going to add that to their portfolio, their private equity. They're not going to go out and buy individual properties. They pay an aggregation premium, meaning that they want it bundled up and they want to be able to put a $500 million chunk into their portfolio. So that's going to be the end game for at least for our firm, for most of these types of programs. Whether it's multifamily, we'll bundle up, our first multifamily program sold in less than 3 years, and it was a nice return. Without going into specifics, it was a nice return on investment for clients. They were very happy, and that's when we launched Fund 2, and then Fund 3, and Fund 4. So we keep launching funds because the demand is still there. You look at multifamily, right now it's been a stretch for multifamily. The values have stayed pretty low or consistent. We're seeing an upswing, almost like a hockey stick upswing over the coming months, especially as the Fed eventually starts, lowering interest rates and inflation starts easing up and things start easing up. You're going to see just the demand for multifamily go through the roof as well. So I think we have a two-headed monster, maybe a three-headed monster if you want to throw in the 1031 exchanges, going out into the market with multifamily data centers, tax products like 1031 exchanges to be able to really generate the kind of investment that we're looking for our portfolios. I think that honestly the demand is just going to continue to grow. Everything we're seeing is showing that. Especially with data centers, the demand is not going to. It's only going to get more and more. It's only going to increase.
Yeah, I agree with you. The CEO of NVIDIA, I think, was interviewed a couple months ago and said, even if we had enough data centers to cover all of the devices out there today, we'd need to double that space within 5 years again. So let me take a step back here and talk about the market of like multifamily. Why did you guys choose this space? I mean, was it what was it about that attracted Carter there? Do you know?
Yeah, it was shelter over shopping. I think so. John has been involved in real estate for a very, very long time, and again, been in data centers since the beginning. Multifamily and data centers work almost you could say they're siblings. They have really good risk-adjusted returns. When you look at the numbers over, let's say, the last 40 years, multifamily has the best risk-adjusted returns of over the last 45 years out of any asset class, any real estate asset class. Meaning that you get bang for the buck. You're going to get least amount of volatility, the least amount of correlation with the markets. Good income, good growth. So the fundamentals are there. And then going back to what we were saying, where it's shelter over shopping, where people understand that, listen, especially now, if you want to buy a home, and in California, obviously it's a lot different, but it's getting that way also in Texas and some in the Southeast. You want to buy a home, you're spending what, 7.25%, 6.5% maybe on your loan, having to put 20% down on a $500,000, $1 million home. A lot of people just don't have that money right now.
Sure.
And flexibility, and obviously with inflation and everything else. So I think that a lot of people, especially, baby boomers, they're tired of like mowing the lawn, dealing with, the pool, deal with that stuff. They want to spend time with their grandkids. They want to travel, just like a lot of the Gen Zers, saddled with student debt and that kind of stuff. So you're going to get a more transient generation, especially after Gen Z. They tend to want to move, especially where the jobs are at, and all the jobs are in the Southeast. So multifamily it's a no-brainer, just in terms of just the metrics and everything that we're looking at. And then combine that with data centers, and you got two different strategies that are just incredibly not only lucrative but just needed, critical for people, whether it's shelter or data.
You gave me the answer of the next question that I had, which was really, who is your client that's living in multifamily today? And it's really baby boomers, Gen Z, and I think you've got two different markets. Baby boomers are tired of the lawn and the maintenance, and they want to spend time with the grandkids, and they don't want to worry about what happens if the washer dryer goes out. And then Gen Z, their experiential lifestyle has really helped to grow this multifamily space. Would you agree?
100%. There's last numbers I saw a few years ago, there was almost 155 million renters in this country. Wow. 155 million people.
Half the country.
You look at across the generations, whether it's, you look at Gen X, my generation, we're still smarting from 2008. I mean, that was like right when Gen X was getting going. And I mean, people lost their homes. People had to downsize. People lost their jobs. The millennials and Gen Z saw their parents struggle, and a lot of them don't want to get involved in those same traps. And then again, like you said, the baby boomers, I mean, they want some flexibility. They want some easing of just the responsibilities and the chores. So you have a big group between the four generations, let's say, that rent properties or are going to be renting for the foreseeable future, at least. So that's good signs for someone that's investing in multifamily.
That's great. That's such a great overview of the market. We read so many articles that even if we increase production of housing from what we're at right now in the US at about 1.5 million units a year, even if we went to 2 to 2.25, we still wouldn't meet the demand for housing.
Sure. Absolutely.
And that's a lot of reason I think that multifamily continues to grow. And just to talk about multifamily, what are the benefits of living in multifamily? What are the bonuses and the amenities? This isn't just an apartment complex, right? It's a
lifestyle. It's almost like I don't want to say resort, but it has that feel to it where, you'll have nice cabanas, beautiful pool areas, barbecues. They put in pickleball courts now. Our property in Alabama, we've held due diligence meetings in Birmingham because that's where one of our properties is at. And I'd never been to Birmingham, Alabama before. And we've done a few meetings there, and just looking at the properties. I mean, they back up to like these awesome trails where people ride their horses or their bikes, walking trails, tennis courts, basketball courts. Obviously it's nice because, they come furnished with washers and dryers. We have the smart technology where you don't need your key to walk into the front door. You just use your phone and it senses it and beeps you right in. We have Nest air conditioners that, sense the climate. So there's just a lot of things that are really cool that, you want to downsize. You don't want to worry about having all this extra stuff. You move what you want in. and then you have a nice, nice community where, they do events too, where they have like barbecue nights or Hawaiian nights or whatever it is. They're really involved with the community and try to get everyone involved if they want to be. So they're nice communities and family communities. You see a lot of kids, a lot of people. They have playgrounds in some of them, so they make them really nice.
That's awesome. So it's interesting. I think it's a different world, whether it's university housing. I talk to people about university housing, and college housing is not what when I went to college or when you went to college. It's much different today. Same thing in multifamily. And so I think it's great to live in this time. We have so many different options and creating opportunity to really improve people's lives, and especially when it comes to a lot of these properties even have people who have mobility issues.
Absolutely.
These kind of properties offer a different opportunity for them as well.
Absolutely.
Well, it's been a great time having a talk with you. A lot of times I don't know where my conversations are going to go. So I might have a plan when I start.
It's fun, man. I love the format. I love having these kind of conversations. This has been great, Herb. Thank you.
Awesome. So I always like to end our program with a question. I'm a cartoon person. So here's a couple of questions. DC or Marvel?
Marvel.
Looney Tunes or Disney?
I'm going Looney Tunes, man.
If you had a favorite cartoon character, who is it?
Probably Homer Simpson.
Nice. Awesome.
I relate to him, No, just kidding.
Exactly. Well, folks, that's a wrap. Don't forget to like, subscribe, and stay tuned for more raw financial talk in the Sandbox. Thanks so much for joining me today. It's been really fun having you on, and I look forward to inviting some more folks from Carter down the road. Thanks again.